that you all may own. Uh, so basically, all for-profit businesses in the United States are subject to income taxes. Uh, there are four major types of businesses that we look at for tax purposes. The first being a sole proprietor, which is a business normally owned by one person that is not a partnership, it's not a corporation, but it is an individual who has a business, and it's normally a single owned business, a single person owned business. So that particular business is subject to income taxes, and the taxes on that business are incorporated in the individual's personal income tax return. It is reported on what we call a Schedule C of your personal tax return. The second type of business that we are looking at is a partnership return. So a partnership return is normally a business that consists of two or more persons, and that business is to report as a partnership, and each partner is given what we call a Form K-1 from the tax return, and that K-1 shows the individual's portion of the profit and loss of the business, and that K-1 is also reported in the individual's personal income tax return. The third type of business is a C corporation. A C corporation is said to be a separate entity. It is separate and apart from an individual. That C corporation reports separately, and the income and expenses are subject to taxes outside of your personal income tax return. The last of the four entities would be an S corporation or a subchapter S corporation. And that is a corporation that has requested S Corp status from the IRS and has been granted S Corp status. And S Corp status allows that corporation to reflect its profit or losses similar to a partnership on a K-1, which is, again, a form that goes into your personal tax return. So each owner of the S Corp is then given their pro rata share of profits or losses. And again, that amount that that person receives is subject to income taxes at their individual tax rate. Any questions so far on the four types of businesses and their taxes? Okay, so second to that would be the basis for the calculation of taxes. So for each of the entities I spoke of before, taxes are based on profit or loss. And that would basically be a calculation of the income that the business generated, less any expenses, allowable expenses for the tax period. And so if revenues exceed expenses, then you would have a gain, and that gain would then be subject to tax. If the reverse happened, if your expenses exceeded your income, then that business would reflect a loss, and that loss would be reflected into your tax return. For each of these entities, each of the entities, loss is treated differently. So under a sole proprietorship, loss would reduce other income. So if you had a job and you had wages that you earned in addition to your business income or loss, if you earned $50,000 and your business had a loss of $10,000, you would then be allowed to reduce your taxable income, your $50,000, by the $10,000 loss. The same holds true in a partnership. If in your partnership, your K1 reflects a loss, then that loss would then flow into your personal return and be allowed to reduce other income. Under a C corporation, losses do not flow through to your personal return. Losses are not subject to income in the year that they're reported, but they are allowed to carry back or carry forward. So a loss carried forward or carried back would then be allowed to reduce profits from a previous or a future year in that corporation. So if you had a loss in 2024, but you had a gain in 2023, you can amend that 23 return to reduce what you had as a profit in 23 and possibly receive a refund based on that. The last of the four entities would be the S corporation. And the S corporation again has a form K1, and the K1 from that S corp would then flow through and reduce your personal income. Okay, so I see the question in the chat box. An LLC is certainly a entity. It would fall under one of the two entities we spoke about. So a single person owned LLC for tax purposes is considered or treated as a sole proprietor, and it would be reported on a Schedule C. An LLC that is not a single person owned LLC is then reported and treated as a partnership for tax purposes. So the partnership return is Form 1065. Let's see. I have an S corp under LLC, which is still confusing to me. Okay, so S corp under an LLC is considered an S corp. So again, that would require that LLC get permission, first of all, from the IRS, and that request is then sent back to you all in writing, saying that you do have S corp status. And the S corp status would be reported on a 1120S. And again, that income or loss would flow through to your personal return. The next subject that I'm going to speak about is self-employment taxes. So both the sole proprietor and the partnership, any profits that are earned through those two entities would be subject to what we call self-employment tax, in addition to your income taxes. Self-employment tax is basically the payment of Social Security and Medicare on the profits that that particular business owned. So that amount, if you worked for someone, your Social Security and Medicare is paid partially by you as the employee, but that amount is matched by your employer. So for sole proprietors and partnerships, you are your employer per se. So you're made to pay, in addition to your income taxes, an additional amount of self-employment taxes. Any questions on self-employment taxes? So the Internal Revenue Service and the state of Louisiana requires that business owners estimate their income tax liability on a quarterly basis. And so each quarter you're made to look at your business and estimate, is it going to have a tax liability at year end or not? And if it is, you are made to pay estimated quarterly tax payments. So on the 15th of April, July, September, and January of the next year, you're made to look at your business and estimate your tax liability, including self-employment taxes, and that amount is to be paid on a quarterly basis to the Internal Revenue Service. And that is normally done through a 1040 ES, which is an estimated tax return. Uh, the due date for income taxes, each of the forms that we spoke about before, each of the business types, the due date for those taxes would be March 15th. If you are a calendar year filer, if you are not a calendar year filer, then you would be made to report 3 months after your year end. And that is without extension. The extension will then, if you file for an extension, then that would give you till September 15th if you're a calendar year filer. Understand that an extension to file your tax return is not an extension to pay. So if you do have a tax liability, that tax amount is due on the initial due date of the return, which would be March 15th. So if you choose to extend your filing till September 15th and you have a liability at that point, you will be penalized from March 15th all the way until that amount is paid because you do not have an extension to pay. There is no extension to pay, only an extension to file. Okay, in the calculation of taxes, uh, the profit of businesses is then subject to the tax rate. And so for corporations, for C corporations for 2024, the corporate tax rate is 21%. For individuals and for partnerships and for S corps, again, that amount would flow through to your personal return, and personal returns are subject to income based on the amount of earnings. And so individual tax rates range from 10% all the way up to 37%. So your profit could be dependent on your other income, could be subject to 10% of taxes or as much as 37%. And that does not include your self-employment taxes. Self-employment taxes is normally around an additional 30% of your profit. So any questions on tax rates? So any questions in general about taxes? If we can, I guess, hear some of your individual concerns or questions that might help me address some things.
I have a quick question. The 30% of self-employment tax,
Yes.
uh, is some of that like withholding for your retirement, et cetera, disability, or what does that all go to?
Okay, yes, that does. It is the amount you are contributing to your retirement, your federal retirement through Social Security and through Medicare. So
Mhm.
basically, the way that system works is based on quarters earned. And so if you are an employee, you earn quarters basically while you're working. But when you're self-employed, you made to do that process for yourself. And so that 30% is basically your contribution to the retirement system.
Thank you.
You're welcome. Hello? Yes. Is that a question, Emily? That's it. I'm seeing Emily on the screen, but I'm not certain Emily is muted.
No, I'm sorry, you
Okay.
answered my question.
Okay,
Unless
all right.
Emily in here.
Okay, all right. Sorry about that. Uh, again, uh, record keeping is part of this process, the ability to support a tax return. So, uh, any numbers that go into your tax return are your numbers. And from an IRS standpoint, you are responsible to provide proper support for those numbers. When you report expenses, again, you have to have the proper documentation to reflect the expenses that you're reporting. That would be canceled check, uh, debit card entry, some form of proof that the expense took place, along with a receipt to show or contract to show what exactly you were paying for. You're also responsible for the proper reporting of your revenues. If audited, the IRS will look at your bank statements to see any income that was generated. If you are not able to identify what those expenses are, or income items are, the IRS are going to treat them as being taxable. So it is important that you both understand and properly record into some type of accounting system your both income and expenses. Uh, One of the things we talked about in the previous session was the expense of depreciation, which is an expense where you have a fixed asset that you are spreading over time. And with that, for tax purposes, oftentimes that process of expensing that asset can be accelerated. And so for tax purposes, oftentimes there's what they call a Section 179 deduction that allows you, if profitable, to fully deduct the amount of a fixed asset or some types of fixed assets in the year that they are purchased. Those are normally equipment type items, items that would normally be subject to 5 to 7 year depreciation. They are then allowed to be fully depreciated in the year that they were purchased. Also, most all of these tax returns, maybe with the exception of the C Corp, are normally reported on the cash basis of accounting, where expenses are recorded when paid, income is recorded when received. So there's quite often a difference between what your books reflect for a given period as opposed to your tax return. So your tax return is normally on a cash basis, where your financial statements are more often than not reported on an accrual basis. I think that basically covers what I have outlined. But again, if there's any questions specific to your business or concerns you may have, feel free to ask your questions.
I'll ask the question to get the ball rolling. How should businesses manage their sales taxes? What are the different ways that a business can make sure that they're doing that properly?
Okay, so sales taxes are separate and apart from income taxes. Sales taxes are basically a service that the business is required to perform for normally the state and the parish. Uh, those taxes are based on your actual sales, and they are due to the reporting entity on the 20th of the month following the close of the period. So November 2024 sales taxes are made to be paid by December 20th, 2024. That tax is basically your sales times the tax rate. You have both state tax, sales taxes, as well as parish taxes. You are made to report parish taxes in each parish in which you are doing business. So if you're doing business, or each state that you are doing business, uh, there are entities available. So for individuals who are doing sales across the country, that process would be a very difficult process. It would be advised that you use an entity that specializes in that to help you report your sales properly in each of the uh, entities or each of the uh, parishes or states that you are reporting. And again, that is not an expense to the business. Your sales are not based on your sales tax amount. So when you record sales, sales are separate and apart from sales taxes. And so sales taxes is a liability to your business. When you collect money on behalf of the parish or the state, that is not your money. And so it is important to separate that money from your money as early as possible. But again, it's due to the reporting entity by the 20th day of the next month.
There are a lot of point of sale systems have automatic features that can help set aside this money and remit it to the state.
Certainly, yes. Most cash registers or point of sale systems will reflect both your state and parish taxes separate and apart from sales.
Does anyone have any specific questions about their business tax returns? I'm sure there's a bunch of people on this call. I'm sure some people have some specific questions. This is a great opportunity to ask a tax preparer before you start putting things together. Feel free to use the chat box too. Yeah, doesn't seem like we have any additional tax questions. All right. If you do have something that comes up and you are not sure about it when it comes to your business filings, please reach out to me. I'll connect you with Leo if you have a specific question. I'll be very happy to answer it. If I can't answer it, otherwise, yeah, this is a relatively short session. So you get 30 minutes of your day back. Yeah, this is the final learning session of the year. So if I don't see you at the event, have a great holiday season. I'll see you in 2025. And Leo, I'll see you at 1 o'clock.
I'll see you at 1 o'clock. Yes.
All right. Thanks,
All right.
everybody.
All right. Thank you all.